My name is Rob. I organize Idea to IPO. We've been doing events in Silicon Valley for many, many years. We have a busy, busy calendar of events. I want to highlight two events that are coming up. Later on this week, Deep Learning 101, September 19th in Sunnyvale. Next Thursday, the Venture Capital Panel, Investment and Latest Innovations in Machine Learning at the College of San Mateo. Check out the details for those events and all of our events on our website, ideatoipo.com. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 60,000 members among all our meetup groups in the Bay Area. We've organized, promoted, and produced over 2,100 events. By any standard, not yet, by any standard, by any measure, we're the most active, most prolific startup event organization in Silicon Valley, bar none. Now, all right, appreciate that. Our mission is to promote entrepreneurship, support entrepreneurs, build community, and provide value in the Silicon Valley startup ecosystem. To that end, we provide content that is practical, actionable, and relevant, stuff you can actually use to succeed as entrepreneurs. We believe in building community because Silicon Valley is an aspirational ecosystem. It attracts people from all over the world to come here to do great things. Who here is not originally from Silicon Valley or the Bay Area? Who here was born and raised in Silicon Valley or the Bay Area? Two natives. Welcome. Let's welcome our natives. With regard to value, it's important that we provide value at each and every one of our events. Not just value for your money, which is important because we know many entrepreneurs are struggling financially. So we make sure our events are affordable. If you cannot afford the cover charge for whatever reason, come talk to me and we can work something out. And at each and every one of our events, we make sure that we provide a delicious buffet meal. Is that a delicious buffet meal? Well, let's hear it for Royse Law Firm for sponsoring that delicious buffet meal. And let's acknowledge our executive chef, Carlo, who also works at a Michelin star restaurant. Carlo. Most importantly, though, at each and every one of our events, we want to make sure that we provide value for your time, which is your most valuable resource. Anyone here getting any younger? Besides our speaker? I need to mention, though, our speaker is having his birthday, and it's going to happen in about 5 hours. And he's turning 29. So we will, FYI, be having a birthday cake and ice cream at the end of the formal program. So please stick around. We have many, many partners that help us do what we do. Law firms, venture capital firms, angel investor groups, incubators, accelerators, colleges, universities, lots of other players in Silicon Valley. Tonight, we're grateful to Interstate for hosting us at this beautiful venue. So let's hear it for Interstate. Let's hear it for Matt.
Hi. Thanks for coming tonight. It's always a pleasure working with Rob and Royse Law Firm, Roger. It's great having them come over, and there's always so many good topics. I learn a ton too, and we've had groups of all different sizes throughout the space. Thanks for coming. Please make yourself at home, enjoy the food, and I'll be walking around too if you got any questions. If you guys know anybody that needs space too, we're here. So we've got private offices, dedicated desks, flex space, conference rooms. We kind of book it all out, and it's super fun meeting all the different companies that are growing and going in the Bay Area. So thanks for coming, and enjoy the evening.
A few of our other partners are here tonight. I would also like to have them come up and say a few words. Let's hear it for Jackie and First Republic Bank. Applause.
Hi, everyone. My name is Jackie Huey, and I'm a relationship manager in our Palo Alto office, and I'm part of our tech banking group. So we focus on providing personal and corporate banking services to founders, their companies, and their employees. So in addition to waiving bank fees for the first 2 years, we also have something called the Innovators Toolkit, which are additional resources for our clients, such as AWS and Google Cloud credits. And there's a whole bunch of other services that could benefit you. So please afterwards, if you have any questions, please come stop by the table. I'll be happy to talk to you. Thanks.
All right, next up we have happiness factors and Anita. Applause.
Hi, as many of you know, I'm Anita, founder and chief strategist of Happiness Factors. At Happiness Factors, we strive to create happy mindsets globally, so much so that we eradicate death by suicide. We disrupt unhappiness and provide emotional wellness tools on a platform independent software which can be used on your iOS, Android, or even on your laptop. And we do lots of workshops, coaching, and trainings across the globe as well. So if you're interested to find more about how to be happy without drugs, marijuana, or alcohol, and not just find it, but also sustain it, come see me and you will get as high on life as I am. Thank you.
Just in case, though, again, we have ice cream and cake, cheesecake at 8:30 p.m. Just in case. Next up, we have Beyond Earth and Fred. Applause.
Greetings, Fred Radford, Beyond Earth. We're a new space startup, and we launch rockets to send small satellites into orbit for under $1 million. So if you're interested in space, new space, come see me. Love to talk to you, tell you what we're doing, and invite you to our community about space. Thank you.
All right. Next up, we have Cruise Ship and Brandon. Applause.
Does anybody want to take out Facebook or Instagram? I want a lot of advisors and mentors, and right now I need some tyrants. So come see me after, and we need a lot of beta testers right now. We're launching in 1 month, so as much help as you can give. Thank you.
Though our local mission is to support entrepreneurs here in Silicon Valley, our global mission is to democratize entrepreneurship and innovation all around the world. To that end, we maintain a robust YouTube channel, youtube.com/idea to IPO. Go check it out. We have tons of videos there. We've documented and archived many of our events. And this rich, valuable content is available on demand, anytime, anywhere, totally free of charge. Whether you're in Menlo Park, Palo Alto, San Francisco, LA, Maui, Moscow, or Timbuktu. And our partner in this endeavor is Tim Jeggers of Jeggers Films, one of the top professional videographers in Silicon Valley. Let's give it up for Tim.
Thank you, Rob. Thank you, everybody. So I'm Tim. I've been working with Idea to IPO for a couple years now. Prior to that, I've been doing freelance video production, photography, multimedia, and content creation. I handle everything from pre-production to actual production to post-production. So if you have any questions about any of that stuff or anything relative to multimedia in general, if I don't know how to do it or have an answer for you, I could probably point you to the person that does. Thank you.
Okay, here's the schedule for the rest of the evening. Our featured speaker will present. He's got an awesome slide deck. Audience members, hold your questions until 8 p.m. At that point, we're going to open it up to audience questions. We'll take as many questions as possible till 8:30 p.m. At 8:30 p.m., we are going to have a raffle. We have 3 copies of Roger's book, Dead on Arrival. Nice title. How to Avoid the Legal Mistakes That Could Kill Your Startup. So we'll be circulating the fishbowl. If you haven't had a chance to enter, your chances look pretty good tonight. After the formal program, we're going to do cake and ice cream. You can stick around, network, socialize, and connect. As a courtesy to Interstate, we would like to leave the building by 9 p.m. However, we will have an after party at the Hotel Nia, a few blocks from here. And I do believe that the drinks are sponsored by Royse Law Firm. So stick around for that. And if you need to get up at any time during the formal program to get more food, use the restrooms, it's okay. It's a very informal atmosphere. We're here to have a good time tonight, hopefully learn something. So without further ado, I want to introduce our featured speaker tonight. He is one of the top startup and corporate attorneys in Silicon Valley. He's the founder of Royse Law Firm. Actually, he's an iconic figure in Silicon Valley. He is everywhere. He's at meetups, conferences, social events, at the Rosewood, Hotel Nia. He's everywhere. He's Roger Royse. So let's give it up for Roger. and he is passionate about helping entrepreneurs succeed.
All right. Thanks, I think, Rob, for that introduction. Not quite sure. Thank you all of you for coming out tonight. We're going to talk about funding 101 for startups. How many startup entrepreneurs in my group here tonight? How many investors? Let's get a few investors. All right. Service providers like me? All right. Couple. Anybody else? Any category I missed? Movie stars? I don't know. We've had that, by the way. All right, so we're going to talk about funding, and this is just kind of a nuts and bolts set of slides. This is original content. I put this all together one weekend a few weeks ago, so I'm a little curious myself what I'm about to say. And we're going to talk mostly about, sources of funding, where it comes from, how startups get funded, where they find it, what kind of terms you can expect. It's really, like I say, nuts and bolts about the funding. There's no magic bullet here, so you're not going to, well, maybe there is if you stick around long enough. I'm not going to get through all of these slides. I'm going to go through really fast. I'm going to hit the high points. For those of you that don't know me, I'm Roger Royse. I'm the founder of the Royse Law Firm. Our main office is about 2 blocks away from here. We're about 30 lawyers. We are full service to the technology startup community. It's all that we do. And we work from startups from idea to IPO, in fact, right from inception to exit. With me here tonight, Steve Colby is in the back. He's a patent lawyer. I do corporate and tax. Steve does patent law, so if you have a patent issue, make sure you talk to Steve. So let's just start right from the beginning, the big question, where do I get money from? Here's a good list, and by the way, if anybody wants these slides, just leave me a card and I'll make sure I'll send them to you. A good list of the most common sources of funding, and this is what we're going to walk through tonight. So let's go through these one by one. This is research from Fundable, by the way, which shows where startups get this is their early stage funding. And not just startups, but any new ventures, new companies that make it onto Fundable. Sort of surprising how much personal money founders put into their company, right? 185 billion in this example. It's surprising how much startups get from their friends and family to get launched. And then after that, it's venture capital, angel investors about the same money. This number surprised me as well. Banks will actually lend, like First Republic over here, to startups if you got good collateral. And then crowdfunding, which we'll talk about later. And we're going to add another category right here where my R is on ICOs, so which did make it onto this chart. So let's go through most of those. Pretty much, most startups are going to have to get some money from their founders to get going. So I'll just give you the bad news. That's just usually it takes, you're the founder, you believe in your company, you have the vision, nobody else does. Most companies will start with a little bit of their own money. Now, I don't have a chart on the statistics here, but I will tell you that even here in Silicon Valley, most startups are not successful the first time out, right? It takes most founders a few times to get it right. So you need to keep that in mind. And the last thing in the world, and I've sat in meetings where I've heard lawyers say to their startup founders, oh, you should mortgage your house to fund this. You should raid your retirement account. And I've known a lot of entrepreneurs that have lived off their 401ks while they got their company started. I'm never going to tell you to do that, right? This is one of those cases where you gamble as much as you can afford to lose to get started, and then you use other people's money. It is a very, very high risk game. Tremendously high reward, but correspondingly very high risk.
Roger, 70% is a nationwide?
We're gonna do questions after I'm finished here. So you might want to just hold your questions so I can get through as many slides as I can. Yeah, these are national. Whoops. What did I do here? Oh, here we go. Debt financing. So founders' money. Debt financing, that's bank debt, that's security. A couple of things about debt financing. Yeah, I do see that more than you might think, especially get a company credit card. One thing I just want to warn you folks is if you do this, most financiers are going to want some sort of security. There's very few commercial financiers that are just going to give an unsecured loan to a startup based on a promise and a wing and a prayer. So they will probably want a personal guarantee. You know, just be very sensitive to what that means, all right? It means you're on the hook. So don't think that debt financing is something that you can just walk away from if things don't work out. It's not expensive money. It's cheap money, but it comes with a very high cost in the sense that it has to be repaid. You know, our firm did an entire 1-hour webinar on government grants. And this is one that people tend to forget, and they really should. There is a surprising amount of money out there available from the government, you know, if you know where to look. Department of Energy, if you're clean tech. Department of Agriculture, if you're ag tech. Defense Department funds a lot of things. They have lots of grant money to give away. The state of California has got 1 million little pet projects that they will put money into. So this is really something to pay attention to. I've given you 2 links here. One is USA Government, has a list of all the places you can get grants. The second one is a company here in Silicon Valley that I know very well called the RRoyse. They actually will help you find money and will help you write those grant applications. Almost every company that has any sort of social good or social purpose should be looking into grant money. It's free for the most part. It's the cheapest money you're ever going to get anywhere other than revenue. Friends and family. Almost 40% of startup founders are going to get money from friends and family. Just one step up from founders. This is an interesting number from Fundable. They don't raise very much. It's a pretty small amount on average. I mean, a typical friends and family round that we see here in Silicon Valley is going to be a lot more than that. It's going to be 10 times that. You know, usually I see companies raise a couple $100,000 from friends and family before we even go talk to angels. But most companies, you know, I guess the national statistic is, you know, more than a third. But keep in mind, this is probably the first place you're going to go. It's not to all your rich uncles. Get them all to chip in a little bit of money because they'll invest before you have traction. Does everyone know what I mean by traction? It's that magic word. That's what all the professional investors and even the angels now in this valley want to see. They want to know people are going to buy your product. That's traction. They need proof of that. And you know, here in the valley, the investment community, even the angels and the angel groups, they're really spoiled because the best companies in the world end up right here in Silicon Valley. And an angel group, you know, or an angel, they don't really have to look very far to find, and the bar is high, the criteria are strict. They don't have to go out of this geography, first of all. They just don't have to. So I know a lot of you might be from other parts of the country. Just keep that in mind. You know, angels, unless you're really hot, you know, if you've got something that has to be, you know, in some other geography, they just don't have to go there. Number 2, these days, it wasn't like this 10, 20 years ago. But these days, you know, even to go to the angels, you better be able to show traction. Friends and family, not so much. They'll take your word for it. They'll believe in you and your vision. Angels here, almost every company now, because of, you know, what happened with Web 2.0 15 years ago, what's happened even more recently, it's just so easy to build a product normally and get it out to revenue that's what they're used to seeing. So keep that in mind. So angels, angel fund, we all know what angels are, right? Now the interesting thing about angels is unlike all these other investors, they're generally hard to find. They just are. They're not advertising. There's angels among us that you don't know about because once you know they are, then you blow their cover and they're going to be talking all night. So seriously, the angels that I know, they're not coming to events like this unless it's something that really is compelling that appeals to them, and then they'll come out to listen to that content. But for the most part, they're not advertising. They don't have websites. You need to approach them through warm introductions. That's how you find angels, okay? And you need to find people that have an affinity for what you're doing. I think that's the best way to do it. The angel groups, on the other hand, they run interference for you. We actually host, in our law firm, every month we host several different angel groups that come and sit down and listen to pitches. Some of them fund a surprising amount of the companies they see because the selection criteria is so strict, to get in front of them. With angel groups, you can go out there and you can find them online, you can read all about them. You don't know who the people are behind it, but you know that they are a group and they're serious about spending money. And of course, we've now got this thing called angel funds, especially through some of the online marketplaces like AngelList. Individuals can get together, they can form a fund online, and you can just market through them. Who's the Israeli one? Biggest one in the world now. Crowd something. Our crowd. Big angel fund online. There's a lot of them. We'll talk more about how they do that as a legal matter now, but suffice it to say the law changed a little less than 10 years ago to allow angels to get together, put a fund online, and you can actually go apply and interact with them online. So big difference. You can actually solicit them online. Okay, so before we even get into the venture capital stuff, because I know that's what everybody wants to hear about, I want to talk about what you would do, once you get that angel. What are you going to offer them? And keep in mind, we're in Silicon Valley. People's attention spans are slow. They got tons of deal flow coming at them. You need to be able to talk the lingo, and you can't go in without a clear idea of what's going to happen. So here are the typical securities that companies have. All right. Common stock. Every once in a while, not so much around here, but once you get outside this valley, every once in a while you will see a company make the mistake of wanting to sell common stock to raise money. Okay. Common stock is for your founders, it's for your service providers, it's currency. You want to keep the price really cheap because you're giving that away to people in order to provide services to you. It's for your advisors, maybe even your consultants. It is definitely not for people with money, right? Because if you sell common to raise money, you're either going to dilute yourself too much, you're giving away too much of the company because the common stock is very cheap, or you're going to have to jack up the price of the common so that it's not attractive to the optionees. Okay, let me pause on that and come back to that for a minute. Does everybody know what I mean by common stock when I say common? Common stock is generally the residuary. You have preferred stock, you have common stock. Debt, well, first there's debt. That takes the first money in when you sell your company. Preferred stock will recover its preferences. So preferred stock gets paid before the common does when you sell your company. And then the common gets what's left over. Okay, it's the residuary, right? So it has the lowest value, typically, lower than preferred. Now, we want it to have a low value because when you put an option plan in place and you grant options to all your service providers, because you don't have cash, you're a startup, you got to give them equity, that's your currency, their exercise price is going to be the fair market value of the stock. We want that exercise price to be as low as the law will allow, right? And if we sell common to raise money, that's going to put pressure on raising the exercise price so you don't give away too much of your money. That raises the value, that makes your options much less attractive. Don't fall into that trap. I've seen people do that over and over again, but that's not how you raise money. You keep the common for people you're going to give it away to, or maybe even sell it to be service providers. What are we going to give the investors? All right. It used to be convertible notes. So a convertible note, that was the idea, and I know this is old hat for a lot of you, but let's get us all on the same page before we get into the more arcane stuff. The convertible note is the idea that the investor is going to loan money to the company and on a short-term basis because of the way the regulations work, especially here in California, maybe a year, maybe 18 months. And within that time, if the company does a financing with a VC, that loan will convert into stock, okay? And they'll get better terms than the VC did because they got in early, they saw the future, they helped you out when no one else would. So they get a little bit of a discount. Trouble with the notes are, number one, it has to carry interest. Number two, it has to be repaid. So if you don't do that financing, now you're in default under your note. Now, as a practical matter, these notes are never repaid. They never were. Either you were successful, you did financing, and the note holder got stock, or you were unsuccessful and you did not do a financing and there was no money to pay the note, so it just went into default. Sometimes that meant the creditor ended up with your company because now you're in default under a note. I've seen that happen many times. Okay, not a good result for anybody, really. So that's why this thing called the SAFE, Simple Agreement for Future Equity, came along. That one. The SAFE is the idea of convertible equity. That's like a convertible note that doesn't bear interest and doesn't have to be repaid. You, the investor, you just hang out there, right, until we do a financing. Might be next year, might be 5 years from now, but you just hang out there until that financing happens. If it doesn't happen, you don't get anything. All the other terms tend to be the same. You get in at a better price than the VCs, 20% discount, and we'll put a cap on the price you have to pay so that if something goes crazy and the value goes way up through the roof, you know, your investment isn't going to get diluted way down. In other words, I'll give you $100,000 on a $10 million price cap. That means I'm going to get 1% of this company. I'm going to get 1% of this company no matter what. That's the idea of a price cap. You always have that. Now I want to pause on that for a minute, even though I'm being recorded. One of the more influential accelerators in town has been promoting the idea of uncapped safes and uncapped notes, and I've been hearing that a few times. I could go on and on why I don't think that's a good idea for anybody. The investors don't like it because, again, they want the benefit of getting in early, right? So they want the price cap. They want to know their 100,000 is going to get some minimum percentage of this company. So the investors, if they're sophisticated and savvy, are going to push back on that real hard. The other thing that happens without this price cap, if we have an uncapped note or a safe, is I have actually seen this happen. You might have early investors trying to talk the later investors into investing at a lower valuation, believe it or not. You set everybody up at cross purposes. It's really a bad idea. Just, you know, stay with the market, stay with a price cap on your safe. Preferred stock, we'll talk a lot about that in a minute. That's this idea that you sell stock to the institutional investor. When you sell the company, they get their money first, and then you share what's left over. And then finally, there's this thing that pops up once in a while, royalty financing. I think of it as debt, and that's the idea that, I'll tell you what, Mr. Investor, I'm going to give you X% of my revenue in exchange for this money. Or I'm going to give you X% of the revenue from this product in exchange for this money. Or I'm going to give you some other metric that is really a royalty. It's tied to a revenue stream. Just so you know, if you do that, again, the investors are going to view that as debt, right? Investors don't like to see a lot of debt on your balance sheet because that comes ahead of them. You know, it comes to pay, you know, the debt gets paid first, and they hate that. So be careful about royalty financing. You got to think really hard whether you want to do that. Okay, let's say a few words about venture capital. I wrote an article about 10 years ago, got picked up in the press. In fact, it got the most views of anything I had ever written, and I cranked it out in about 3 minutes. And the name of the article is Why Venture Capital is Money of Last Resort. And then I got hate mail from VCs. So, but, you know, some of them are, you know, the honest ones, you know, I think they agree with me. You know, this is money that is very expensive, and you only take it if you're in what is a typical client for me. High risk, explosive growth, high return, right? So as long as you know that you're going to have to compensate that VC for the tremendous risk they're taking, then okay, then you're in VC land. If that's not you, if you don't have that possibility to be a unicorn, you know, explosive growth, extremely high return, the VC is not going to be interested in you, and you should not be interested in them because the money is too expensive. They take too much for it. But let's talk a little bit about the stats. This is the Price Waterhouse money tree. These are the latest numbers. I want to tell you that it is still a tremendously strong economy. We are doing tons of financings in our firm, just almost, you know, just every day. And you can see why Q2 19 is, second quarter 2019 is already up from Q1. 2018 was the biggest year we ever had, but you can see it's down a little from fourth quarter 2018, but still really strong, super strong. It's over $100 million a year in venture capital, and that's national. Okay. Here's another metric. 2019, we're already at $55 billion this year, $116 billion in 2018. You know, that's the largest this century, largest since 2000. It's still a tremendously strong market. I don't know if you remember 2000, you know, the internet boom. And we're doing this now when we have alternative financing. We've got ICOs competing for money. We've got all sorts of we got crowdfunding competing for money. So this is really significant. There's a lot of venture money out there right now. It's a great time to be in the market looking for money. Here's some more stats. Same idea. We're having a record first half funding here in 2019. It's the biggest it's ever been this century, again, since 2000. Where's the money going? FinTech is number one, right? FinTech's getting most of it. Number two, artificial intelligence. Three, digital health. Cybersecurity is strong. Auto tech, that's one kind of surprised me, but I think we're talking about, cars, driverless cars, things like that. HR tech, on-demand, industrial IoT, which would include ag tech, insurance tech, and consumer goods. So that's where the money's been going to lately. This is interesting. If there's any doubt where you want to be, you're raising venture. Let me just put that doubt away. Look, the top 5 locations, 3 are in California. And by the way, I mean, we have an office in Los Angeles. I go down there, I do these presentations. Even in Los Angeles, number 4 market for venture capital is nothing like it is up here. There's just no comparison. You are in the right place at the right time. So Silicon Valley, New York, Boston, LA, San Diego. And then some of these other also-rans are way behind and kind of surprising. Chicago isn't. We do pretty well in Chicago too. Okay, I'm going to spend a few minutes talking about what kind of terms you might expect when you go talk to a VC. Like I said, they're always going to want preferred stock. And the big question that's going to come up is, how are you going to value your company? What am I worth? What am I worth to a VC? I want to mention, I guess I'd like you to know there's a fair amount of artificiality around that valuation, okay? Valuation is just a number that backs into what % of your company you're going to have. And I've heard it said by more than one VC that the way they value a company is they figure out how much they need, which is usually it's between 20 and 40%. They said, this is how much this company I want, and they're going to back into it from where they see the exit. They figure out how much money the company's going to need to get to the next round, and poof, that's their valuation. That's how they come up with it. It's about that unscientific. Now, there are ways that we get to this. I sat down one day and I counted up 30 different ways that I know of that people have used to justify their valuation. Because every once in a while, the VC is going to want you to tell them what you think you're worth. Normally, they give you a term sheet. They go through their math and they say, this is your valuation, right? Normally, they'll tell you what your valuation is. Every once in a while, they might ask you to make an offer and put something on the table. Never volunteer that unless they push you, right? Because whatever number you give them, they're going to cut it in half, okay? So never volunteer that. If you have to volunteer that, back it up. Get your spreadsheets out, find 3 of these 30 methods that converge on a number and say, this is it and this is why, right? By the way, I just read this book recently. It's called Words That Work. It's a really awesome book. And one of the most powerful words in the language is the word because. Like, it's amazing what people will accept if you just put a because behind it, right? You have to stay here for the rest of this presentation because we bought you this free food. You put a because, people say, oh, because, well, that must be true. Same thing, if you're going to give them a valuation, better say, I'm worth $10 million because here's my numbers. So if anybody wants, I've got a big memo on each of these. You can take a look at it. I won't go through these now due to the time, and plus the fact that some of them will make you laugh out loud when you hear some of the metrics. Others of them are very sophisticated, but I've got numerous, like I say, about 30 of them. When I mention valuation, we talked about that. You don't mention it, let them do it. I remember there was a time when everybody, in fact, even now, I still get these executive summaries, and right there at the top, oh, our valuation is X, or we're selling 20% of the company for Y, something like that. Don't do that. Don't do that. First of all, you're going to look like a rube to the investor. They're going to think you don't know what you're doing. And secondly, I'm not kidding. They're going to take whatever number you give them and cut it in half. That's going to be their starting thought. You're giving them an anchor. Congratulations. That's another powerful word. You're giving them an anchor. It's just the wrong anchor. And then secondly, we had talked earlier about this, stage your investments. Really sophisticated investors, they know you want to stage your investments. So think about it like this. I had a company come to me, I remember a long time ago, and they said, we're a biotech company. We're going to need $50 million in order to get all the FDA approvals and take over the world. So we're going to go out and we're going to look for $50 million. Okay, there's so many things wrong with that, right? First of all, no one's going to give you $50 million if you've got nothing. And they actually had products, they had revenue, so they're a little ahead of the game. But secondly, if you do raise more money than you need, you're giving away way too much of the company. So you take just as much money as you need to get to the next valuation point. So I sit down with companies and we strategize. How much money do you need to get to the next valuation point? How much money to get your product out the door? How much to get into this geography? How much to build out, the technology? Whatever it is that's going to make you more valuable. That's all the money you should ask for. Don't ask for more than that. You're going to give way too much of the company away. That's staged investment. And by the way, your investors will appreciate that too. They'll appreciate the fact that you know that and you do that because you're protecting them when you do a staged investment. Term sheets. I'm going to spend a few minutes going through some term sheets. Valuation is not your biggest issue. It's hard. It's hard to get that through people's head, but it's really true. It's not your biggest issue. It's just one issue. There's a lot of other things that are going to make a big difference in how well you're going to do in the deal. And by the way, you will find that the higher tier, the bigger the VC, the more successful the VC, just expect the valuations to be lower, right? Because they can offer that because they've got the pipeline. They can get you to a successful exit. And that's what you really want. Okay, a few things you should be aware of, when you go to talk to these people. Number one, the concept of participation. Participation, so remember what I said about venture capital preferred stock? It gets paid first, right? And there's two kinds of preferred stock, participating and non-participating. Non-participating means the investor gets their money back and then they're done. Or maybe they get a multiple of their money, but then they're done. The common shares in the residuary, shares in everything beyond that. That kind of stock will always have a conversion right, so the investor can convert the preferred into common and take their pro rata share if that's bigger than the money put in. So for example, if I put in $1 million and I got non-participating preferred stock, say I got 10% of the company, if it sells for $5 million, well, I'll take my preference. That's 20%, that's $1 million. If it sells for $20 million, I'll convert to common and take 10%, right? Because that's more than the 1 million I put in. That would be 2 million. That's the concept. Participating preferred, which we don't see that often these days because of the market. We're just not seeing it very often. I used to see it all the time in every deal, but now it's not very often. It's where the investor gets their money back and they get their pro rata share on top of getting their money back, right? So it's a pretty sweet deal. It's pretty company favorable right now at this moment. 5 years from now, it'll be completely the other way around. It'll be, just what we do in every deal. So that's one that changes with the market. Dividends. First of all, don't sweat dividends. Startup companies do not pay dividends. I mean, I don't think in my life I've seen a startup company pay a dividend, at least not intentionally. But you will oftentimes hear this concept come up. The way that these deals are always done in venture capital land is that the dividend is non-cumulative and it's only paid when, as, and if declared. That means that it doesn't, if it's not paid in 1 year, a cumulative dividend gets paid in the next year. It just accumulates. Non-cumulative, it's not paid, it goes away. It's not always non-cumulative, but it's always only as, with, and when declared. And they're never declared. Startup companies, they keep their money to build out the company. They don't pay dividends. The reason I'm pausing on it now is that private equity deals are completely the opposite. Dividends are cumulative, right? And they often will be paid. And if not, they're definitely going to accumulate. That's one of the biggest differences between private equity and venture capital. As private equity firms, they're investing in something with a little less risk, right? But they have a little less on the upside, so they want to get it through the cumulative dividend. Liquidation preference. Who gets paid first and how much? We talked about the preference. That's the idea that the investor gets their money back. Redemption rights. Pretty common these days that the venture capitalist is going to say, you know what, if I'm in this company for 4 years and you guys still haven't exited, you have to redeem my stock and give me my money back. Very common now. And of course, the company is not going to have the money to buy their stock back. So what does it do? It basically gives the VC a right to force a sale. That's what that's for. That's the intention of it. So keep that in mind. You're going to see that in most deals these days. There are a lot of deals, I should say, these days. I won't go through all of these, but there's a million protective provisions that'll pop up. Just expect that when you get in bed with a VC, you're stuck with them. They're going to be, very much in your business. They're going to have a right to block or approve lots of what you do. That surprises some people. I've come away from that first board meeting many times. The founders just stunned, just shocked, at the fact that they've taken on a partner, not just an investor. Keep in mind, that's the nature of venture capital. That's what makes it different than other types of investments. The VC is going to promote the company. They're going to make it successful. They're going to help. They're going to take a big role in management. Information rights, registration rights. We don't need to spend a lot of time on that. It's just a requirement that the company go do an IPO. 35 years of doing this, I have never, ever, ever once seen a company, try to exercise registration rights. It is just mechanically too difficult, and you can't manipulate the market. Board rights. Should have a slide that says board rights. Your venture capitalist is going to take, and when you do your Series A round, the VC is going to get one of your 3 board seats, right? Another one of the board seats will go to the founder for the common stock. The third one might stay with the founder, the common stock. If you've got that much leverage, normally will go to an independent third-party industry luminary. Just expect that. But there's a bunch of investors. They want to participate. They want a seat at the table. So we give them observer rights. They don't get to vote, but they get to sit there and give you all their bright ideas at every board meeting. Wholesale tag-along rights. This is this right to participate. If the founder exits, the VC gets to exit too. If the founder finds someone that wants to buy their shares, you got to give the investor the right to sell their shares in that same sale. That's wholesale rights. Right of first refusal means that the company has a right to buy the founder shares. Then the investor has a right to buy the founder shares before he can sell it to anybody else. Standard stuff, standard protections. I think we talked about board representation. I'm going through this fast because I got some new stuff I want to get to, but I will just mention to you, just expect to invest when you get into an investor, not just a VC. Any investor is going to expect this. And not just any investor. If you have a co-founder, your shares should be subject to vesting. Does everyone know what I mean by vesting? That's a concept that you earn your shares through continued service. And if you leave the company, you have to sell your unvested shares back at cost, right? So the longer you stay, the more shares can't be taken away from you when you leave. That's the concept behind vesting. Just expect that you're going to have to unvest your shares 4 years. 3 or 4 years is pretty standard stuff in this valley. I try to slip by with 3 for founders. Investors usually want 4. We won't get into this, but be careful. This is a real sleeper. This is one someone could use anti-dilution to really take advantage of you. Okay, I'm going to jump ahead a little bit. Oh, by the way, I do want to mention strategic investors. Depending on who you ask, this is the greatest thing in the world or the worst thing in the world. I like strategic deals. They're friendlier. They're easier to get done. We don't struggle over management because you know what I mean by a strategic investor? That's not a financial investor. That's someone like corporate venture capital. They're investing because they want to secure a source of supply. They want to know they can buy you at the back end. They want to keep an eye on you, whatever it is. They want to get into your business. So they're not fighting over control, and they're not, they're going to give you better valuations usually. What they are fighting over is a right to buy your product or a right to buy your company when you go out to market. That's the trade-off. As a practical matter, not to say bad things about strategic investors, because I've had good experiences with them. I know a lot of people say that they tend to be a little disinterested in a company. They won't act as quickly. They won't let them make decisions as quickly. They won't respond. They won't get back to them. They're not as involved as they should be. They're not a real partner to you like a VC is, who's genuinely interested in making a lot of money as quickly as possible from your company. Okay, let's go into some other ways of raising money since you've heard everything else. Crowdfunding, this is old news as well, been around since 2012. We started with rewards-based crowdfunding. That's where you just go out to, Kickstarter or Indiegogo, maybe pre-sell your product, maybe not, but you raise money that way. The benefit of this is that you show the world that people love your product, right? Not so much about raising money. So the successful crowdfunding campaigns, rewards-based crowdfunding, are the campaigns where you're going to raise a lot of money. The last thing in the world you want is a failed crowdfunding campaign. That tells the world that nobody cares about your product, right? So successful crowdfunding campaigns I've seen have already lined up, they already know that they're going to raise at least a certain amount of money. They already know that there's a certain segment of the public that is going to put money into it, right? And maybe they've even got them pre-wired to do that before they even launch. And I've seen companies that have been very successful at doing fundraising, done Series A, Series B rounds, and then go out and do crowdfunding. Why would they do that? Because they want to show the Series C investor, how much the public loves their product. It's a marketing play. That's when it works well. When it's a disaster is when you say, well, I'll try anything. I'll even try this crowdfunding, and you don't market it properly, and it fails, and it's out there for the whole world to see. Be really careful about that. Now, the newest thing is equity crowdfunding. Took forever, but we finally got regulations implementing recent 2012 changes in the law to allow you to sell up to about a little more than $1 million in securities within a 12-month period to anybody, right? Widows and orphans, right? You can sell it to anybody. You just have to jump through a million hoops. I won't go through all of this now. I will just tell you that this is something that I remember when this bill was being proposed. It was a good idea. The concept was, let's just, free up the market. Let's just let people spend their money. If we make it small enough, make it really easy for companies to go out and promote. Just imagine if you could promote your company to everybody in the world. You go advertise it. If everybody in the world could see what you're doing, there are so many people that love health and wellness. If you could just show everyone in the world what you're doing, there'd be a certain percentage of them that would just throw money at it because they love the idea. And then the crowd would decide, right? And people would go online and look at the internet, see what people are saying about you, and the crowd would decide. It's a really good system. That was the concept. What ended up, though, I like to say shouldn't happen to a dog. It ended up being another consumer protection bill. So it's very expensive to do this, relatively speaking, but there are successes. I've had companies that have done successful Reg CF offerings, even though I told them not to, and then went on to do venture capital financing. Had that happen more than once. So if you do this properly and thoughtfully and correctly, it can be a good way to get launched. This is by far most of the deals we do now. Rule 506. So there's two rules 506. One is for no advertising or solicitation. The other one is you can advertise and solicit. The catch is you can only take money from accredited investors. What's accredited? That means more than $1 million of net worth, excluding residents, or you make $200,000 a year for the current year. In the past 2 years, $300,000 jointly. That's accredited. Income test or net worth test. 1933, when that test, was established, that meant rich people. Now it means almost anybody in this valley. So, but still, it's accredited only. That's how we do most of these. And now, you can go out and advertise your company if you only take accredited investment. Now, let me just give you a little bit of stats about this. And by the way, these slides are super text heavy, I know. So I'm not going to go through all of it. If you want a copy, let me know. What I will tell you is just some of the stats. The latest, unfortunately, the only data I could find was in 2016. But you can see who the big players are. This is true today. The space is dominated by just a couple of big players. All right. There are a lot of smaller sites that just didn't make it. In fact, there's one that last year the SEC shut down. Several of them they did, but one locally here that they shut down in pretty dramatic fashion for listing a bunch of bad companies, basically. What security are people selling? the safe, right there. That's by far most of what we're selling. These two categories are safes. That's what's typically being crowdfunded. We're not selling common stock, right? That would be dumb. Remember, for all the reasons I said, we're selling safes, and those deals are getting done. Okay, let me jump ahead. Reg A, I just want to mention this in passing before I get on to more interesting things. Just keep in mind there's another exemption out there. You can raise up to $50 million. It's like a mini public offering. You can sell it to anybody. They don't have to be accredited. I've had a lot of people talk to me about Reg A offerings. Have not done one because they're so expensive. It's like doing a public offering. But just keep in mind that option is available. All right, I want to jump ahead and talk a little bit about ICOs. Rob here and I here have done several programs on nothing but ICOs. What's an ICO, right? That's a funding based on, doesn't have to be blockchain technology, it could be any kind of digital asset. Let's say it's based on blockchain. So we're basically selling tokens out into the market instead of stock or securities, stock or other types of securities. That's an ICO, and typically the token has some utility. In other words, you can use it for some product or service. You can burn it for, I don't know, software services or something like that. That's the ICO, and the idea is that the value of the token will increase over time. You've all heard about ICOs. Has anyone here not heard about ICOs? Okay. Oh, really? Okay. Well, let me give you some examples. I'm going to give you a couple examples of some ICOs in a minute, but first let me tell you about the numbers. 2017 was the big year. Not even on my chart. But since then, everybody says, oh, the ICO is dead. Well, not quite. Not quite. They're still being done. People are still raising money. In fact, look at there. We had a little bit of a surge in May of this year in money raised through ICOs. So they're still out there. People are still selling tokens to raise money as securities. So it's a viable option. Here's some more. Here's one. ICOs, US dollars raised month by month. This goes up to last year. You'll notice here, though, that I guess it was early 2018 was kind of the high water mark for ICO. Since then, it's dropped way down, right? For lots of reasons, most of them regulatory. Average returns early on, people were getting crazy returns from these. In other words, the value of the tokens appreciated dramatically. It really drove a lot of what was going on. Now, not so much. You know, the market's returned to sanity. There are some new models now. So the ICO, we build the token. The token has some utility. You can use it to buy products or whatever. You go out and sell the tokens into the market. They appreciate in value. Think of it like this. Suppose you've got this idea for to create Coca-Cola. So you say, look, I'm going to sell you a token, and this token will entitle you to 1 can of Coca-Cola. And this is going to be the biggest soft drink that ever hit the market. So you buy the token for $1, and word gets around, and there's only so many of them. The biggest soft drink ever to hit the market when it comes out. So the price goes up. So you have people buying that token for $10 a token. And then we use the proceeds from the ICO to build a product, in this case, Coca-Cola. So now we release it. So now you got a token that you paid $10 for that gives you a can of Coke. So now the price crashes again. That's sort of the ICO idea. You can see there's some problems with the model, and we saw that in practice. That actually happened. A couple of different, I'm going to tell you how we solve it, or how we will solve it. IEO is the idea that, okay, well, now I got this token. What do I do with it? How do I realize all this value out of it? Suppose I paid a dime for it, and Coca-Cola's worth $1 a can. I want to get my dollar's worth out of it. So we go on an exchange, and we buy and sell these things on exchanges. Well, the IEO is an initial exchange offering. So instead of the company selling a token, the exchange sells the token. So you've got immediate liquidity. We could talk a lot about how that works and why that's a great idea. The DICO, that's the idea that, hey, you know what? What if that can of Coke isn't worth $10, or what if I eventually figure that out? I should get my money back. Or maybe I don't want you to, I'll give you the money as you hit milestones. I don't want to give you the money, Mr. Company, for your token up front to go build it and then you disappear and go buy a Ferrari or whatever. That's the DICO. That's the newest thing. And then the STO, that's the idea that we have a token that's tied to a specific asset or security. I know we have some blockchain companies here, you know all about this. These are very well known and well established and legitimate ways to raise money. They create all sorts of securities problems here in the United States. That's been the problem. And frequently I have companies come to me and they say, look, I've had this ever since the beginning. We have a token, we're going to do an ICO, but we don't want it to be a security because then I can't sell it to those unaccredited investors. I can only sell it to rich people. And my token, it entitles you to play a game or something, so I need to sell it to everybody in the country for this to work. It's a very low value sort of thing. And we're using, the internet to keep the transaction costs very low. So it doesn't really work to sell it only to accredited investors. And I tell them, I'm sorry, the SEC thinks you're a security, most of the time. And every once in a while, I do see one that is not a security. It is legitimately not a security. It's got so much utility and so little security aspects in it. That is really rare. It's really rare. And a lot of people don't like that answer. So they'll go find another lawyer who will tell them that it isn't a security. And, God love them, good luck to them, but I don't want to be around when it hits. All right. I went through that sort of fast. But this is the big issue. So if you're going to do this, I think the takeaway, what I tell people, I say, look, if you really are going to launch an ICO and it's something that's got that kind of utility so that you need to distribute it broadly to like millions of different people, like the token entitles you to a song or a game or something like that, go launch it someplace other than the US. The US law has not caught up to the rest of the world when it comes to regulating these things. And there are several proposals out there. There's a bill in Congress. There's a regulatory proposal that a group of lawyers here in Silicon Valley put together to the SEC saying, come on, guys, let's get modern here. Come on, get with it. Step into the, into the current century. Hasn't happened yet. And given that it took 5 years just to get crowdfunding regulations, I don't think it's going to happen. So if you're going to do that, I counsel companies, as much as I love you and hate to lose you as a client, I'm going to send you off to Switzerland. Go do it through Switzerland or Singapore or Malta or someplace like that. So is your company right for an ICO, right? Is your company right for tokenization? It very well might be. It's something every company ought to investigate. You ought to look into this. You ought to determine whether this is a path. And I've had companies come to me and say, hey, I want to syndicate my real estate holdings. See, I got something way better than that for you. You're a great candidate for an ESTA security token. So you might be. It's worth looking into. And if you're onto something, it's what they call non-dilutive financing, because you're not giving away equity in your company. You're basically pre-selling a product. I do want to say you have to be super careful, right? The SEC is all over this. If you make a mistake here, it could be a disaster. Here are some very well-known mistakes. So Munchie is a good example. Cease and desist order. Munchie had a token that was tied to the food system. You Munchie, I guess. And you would earn tokens by giving good restaurant reviews. You could redeem tokens for rewards and for, I think you could redeem them even for product. But people were buying them. It's like that can of Coke. They expected them to go up in value. SEC, that was enough to make it a security, cease and desist. But the DAO token was another one that was tied to the success of the company. The other thing I want to mention is even if you get around the securities law, you've got Treasury, which has been very active in the space as well. So there's regulators all over the place in this whole space. And the reason why is there's so much fraud. There is so much fraud. I had one just even now, someone almost got past, well, they did get past me. I was halfway through their white paper before I found out it was a fraud. And they came to me and they claimed to have celebrity endorsers. It was about a month ago. And I evaluated the whole plan. By the time my KYC, that's know your customer, came back, I'd gone through the whole thing. I spent the whole day and I came out to discover the whole thing was a fraud. So you have to be super careful in this area. All right, I won't go. And the final thing I'll say is I just want to circle back. Royalty financing, it's not the newest thing on the block. I'm just seeing a lot more of it lately. If you're going to do this, be careful. Again, you want to be strategic. You want to think about this. You want to think, is this going to be viewed as debt by the VC, and is it going to stop me from getting my venture capital? Right? You don't want to do that. If you're going to do royalty financing, have just very narrow places that you can expand upon. Okay, Rob, are we at the end of our time. All right, and with that, I want to thank you for your attention, and I believe that I'm going to hand this back to Rob.
Let's hear it for Roger. So we have a solid 30 minutes for Q&A. We want to take as many questions as possible, take advantage of this opportunity. Roger is not billing you, and he's a very expensive guy. So who's got a question for Roger? There you go. Use the mic, please.
Yeah, you talked about the different types of funding, and I was curious if it's more about the amount of money you need that determines it, or sort of the relationship you need to have with the person giving the money. If you need $200,000 versus $2 million.
Yeah, if you need $200,000, you're in angel territory. You are not in VC territory. They won't talk to you. Well, with one exception, a lot of the venture funds now, they've created their little small angel funds, right? So some of the biggest names in the Valley have small funds that will do early stage investment only so they can like get a first look. They can get a foothold. So when you do your real round, when you grow up and do a venture round, they've got the inside track. But for the most part, that's sort of gimmicky. I mean, for the most part, if that's what you're raising, less, several $100,000, you need to be talking to angels. That's what kind of governs who you're talking to.
On the flip side, if you did want $2 million, would you not talk to angels?
No, $2 million is still angel territory, especially now that we've got angel groups. I'd go to a group for that kind of money because they'll pool a bunch of angels at $50,000 each or $100,000 each and finish out the round. At $2 million, you are in a certain tier of VC territory. Not the big guys, that are doing the bigger rounds, but there's a tier that will do $1 million, $2 million at a time. And again, it's the angel groups and also the angel funds. These are the smaller funds that invest in seed and pre-seed that will make smaller bets. Yeah, there's plenty of organizations that you would talk to at that stage.
Thanks, Roger. I actually have two questions, but they're kind of related, so hopefully you can help me out. So in a fundraising round, there's seed, series A and B. They're like kind of like 15%, 20%, or 20 to 25%. Is it almost always set to those ratios per round, like seed A, B? Or it could vary the percentage of sales of equity like highly drastically?
In this market, it generally is. Okay, let's just put it that way. You got a company that's on an upward trajectory. Their valuations are going up with every financing. Everything's going the way it should. Yeah, you're going to give 20 to 40% away in Series A, and you're going to be about the same amount in Series B, and you're going to lose control in Series B of the company, right? Meaning that more than 50% will be in the hands of the investors. That's a typical ideal. That's how we plan it. That's what we want to have happen. Now, I've heard it said by some smart people that eventually we're going to have a recession and valuations are not going to go up forever and they'll start going the other way. Now, when that happens, all of these economics go out the window. It's like the laws of physics break down, and you see investors coming in and taking massive amounts of the company for smaller dollars. You see pay to play, you see preferred converting to common, stuff like that. But absent those extreme circumstances, yeah, there are some rules of thumb and some metrics you want to follow.
Okay, thank you. Second question is, in a fundraising round, there could be like one investor or there could be like a whole bunch in a round. Who makes the call on like who joins those rounds?
Your cowbell investor, you'll have a lead. You'll have a lead investor typically. You're right. You're going to have a bunch of people that they met out on a golf course that are going to participate with them. But your lead investor will negotiate the deal and everybody else just goes along with it. That's how it's typically done. Can you imagine what a disaster it'd be to have to negotiate with 10 different parties at once? Yeah, deals would never get done.
Okay. So the founders set like one lead investor and
someone will be the lead.
People. Okay, thank you.
Yes. Say what? Mm-hmm. That's just generally what I typically see. I mean, the VC wants to have a, like I say, How much does the company they need? You know, how much money do you need? And typically VCs need that much of a company to get involved. Keep in mind, a VC is not a passive investor. They're an active investor. You know, they want you to succeed. They want to make you succeed. They're going to sit there on your board. They're going to tell you what to do. They're going to be in your hair. You know, they're going to be helpful or maybe not helpful, but they're your partner. So they need a pretty big stake. And a VC can only, they've only got so much money and so many partners, and they can only spend so much time, you know, on so many boards. So they can't be placing small bets. They place big bets, you know, and take big pieces of stock.
Oh, so back to the question, which is 20 to 40%. What makes it 20? What makes it 40?
Oh, that just depends on the investor valuation. That's just a range I typically see. I don't think there's math to this. I think it's more art than science.
Thank you. Quick question. You were talking a little bit about the different ways to kind of introduce yourself to the different people, angels and VCs. You said the warm introduction is really the only, I think, the only example you gave. Other ways that you see work? Is there something that, how do you find warm introductions?
By going to events like this, or going to some of Rob's other pitch events and panels when we have panels of VCs. But let me tell you, the most powerful introduction you can have is by another entrepreneur that VC has invested in. Those are the most valuable people to get to know, right? You know, if you know, big venture capitalist has invested in X company, if that entrepreneur will recommend you back to the VC, they're going to get that's going to get their attention. It's really going to get that's the most valuable thing. Beyond that, it's just the Silicon Valley network and the community. I make a lot of introductions, you know, just because I do a lot of these deals. I know a lot of these people. I'm not saying they all go anywhere, you know, but at least they'll take the call, provided I give them good introductions. You know, if I start just passing along things that don't fit their, you know, their investment thesis, then they're not going to take my calls. But you just need to, you know, yeah, it's easy to find people that know them. And by the way, the VCs I think is easier because they're not hiding. You know who they are. You know what they're investing in. You go on a website, you know exactly what they're looking for. In fact, you can find the person, you know, on LinkedIn who can introduce you to that person pretty easily, or an SV link or something like that, link SV. The difficult ones are the angels, you know, because they're not out there advertising. And you just meet them at events like this, or at pitch events, or at panels.
Just quick follow-up then. Like, if you're saying that angels don't really come to events like this, where do
Oh, they do. They do. They'll
they
go
do?
to pitch events. They'll go to panels for sure. They'll go to investor events. Yeah, no, they absolutely do. So, for example, we do a lot of work with agriculture technology companies. It's just become a niche of ours. When we do an ag tech panel or pitch, it's just full of investors, but they're focused on that one thing, right? They want to talk to agriculture technology companies, and they know they're going to see them. So, yeah, no, they do. They're not here tonight, or at least they're not admitting it, because this is probably not a topic of big interest.
I was wondering if you could.
Oh, now I can hear you.
I was wondering if you could say something about one of the slides a few back that you skipped.
Yeah.
It was. I only got a quick glance at it. It was the local company to, I think it said Cayman, and then I want to fill in Singapore. Yeah,
That
that
one?
one.
Yeah. All right. Well, that's a typical ICO structure. And since you ask, I will pause on it. So this is, so here we got a company now, and they want to go sell a token, and first they need to raise money for the token. All right. And what is a token? It's a digital asset, just a piece of software code, right? And that software code entitles, you know, whoever the rights owner is, the holder of the token, to some sort of what we call utility, some sort of use, some sort of function. So maybe you can redeem it for music online. There are tokens that do that. Maybe it represents a partial ownership in a piece of art or a piece of real estate. It's digital. It's something, you know, and it's usually supported on blockchain because that's how we get the cost way down for that sort of ownership. All right. But we think that if people buy that token, it's going to go up in value, right? Because just like the real estate increases in value, or just like the value of the service that you're buying gets scarce and increases in value, or just like the network that you're buying into increases in value, that token will go way up. And the more tokens you sell, the more people are on the network, the more value it becomes. But we need to finance it. So step one, what do? We sell this thing called a SAFT. Remember the SAFE? Well, this is a SAFT, a simple agreement for future token. There you go. I'm glad you're paying attention. Right? So we take the money from the SAFT and we go out in a platform company. That's the US company. They take it and they build the software, right? They build it. Well, now we've got our token built. Now we go do our token offering. So we're going to sell these tokens. And keep in mind, it's not just for rich people. You know, this token, you exchange it for, you know, some games. Gaming's a good token. You can exchange it for swords that you use in your game or whatever. I don't game, so I don't know what you do in those. But you can exchange it for stuff that a lot of non-accredited investors want, you know, and you really need mass market appeal. So you can't do that in the US. You just can't. I'm sorry, I have to tell that to people all the time. The securities laws just won't let you because it looks too much if it's a security. So we go find a different place. Well, how about Cayman Islands? And the way the deals are often done is there'll be a Singapore company, a foundation, that will actually be the issuer of this security, this token, because under Singapore law, they are much more sensible than the United States. It's not a security. So they're allowed to just sell the token to anybody, right, under Singapore law. Now you have to comply with the laws of every country where the buyer is located, but most countries are not the United States. So the Singapore company sells the token. That's the ICO. Step two, they get the cash. We oftentimes will route it through Cayman Islands because that's a company that has good governance and curbs and gutters and all that stuff. And then the cash gets paid back to the US platform company to reimburse it for all of this, the platform services it's doing. That's one structure that you see fairly frequently. So, you know, that's a typical ICO structure. We used to do that all the time. There's a million variations on that. You know, these days you need the Cayman company in the middle, or you may not need a foundation. You might just go through a Singapore corporation or a Swiss corporation or a Liechtenstein Stichting or who knows. But that's the basic idea.
Thank you.
You're welcome.
Hello. So just quick question about your company. Types of deals are the ones you do the most. Not such a wide.
I know.
range.
I hit everything. Well, we're 30 lawyers. We're full service, you know, but most of what I do is corporate formations, financings, commercial contracts, and then M&A. And these days, I'll just tell you, it's a crazy M&A market. Crazy. I've got clients. I swear to God, I got clients now, more than one that have been my clients since the mid '90s that are now selling. And they said, "This is it. We are at the very top. We're out of this." You know. So it's a crazy M&A market. But here's the odd thing: these numbers, they make no sense at all. It's like because I've been doing this a long time. It's my birthday tomorrow. I'm extremely old. It's true. So I've seen it, but the pattern I've noticed is that we either do a lot of financings and no M&A because people are building up their companies and are very optimistic, or we do a lot of M&A and very few financings because people are getting the hell out. Right now, both are going on. Both are going on, and I just don't get it. I've never seen that before in my life. So we're busy doing financings. We're busy doing M&A transactions. So who knows? I think it's because half the people think that the economy is going to continue on this rise because there's still trillions of dollars, at least about $1 trillion offshore that hasn't come back into the US yet. And about half the people are looking what's going on with real estate prices and they know that we're soon to follow. But whatever it is, it's one of those markets where you ought to be out doing something. You ought to be marketing to sell or marketing to build. You ought to be doing something because there's just a tremendous amount of activity. And a year from now, you know, we're all going to either be alcoholics or gym rats because we'll have nothing else to do and we'll have plenty of spare time. But for now, we should all be working really hard and making hay while the sun's shining.
Regarding financing or all these options, I gather that you are not very fond of
Say that again.
Regarding financing of all these options you mentioned, what will be your specialty? Because I have the feeling that you are not very fond on VCs.
Oh, I love VCs. Don't get me wrong. My best friends are, well, I don't know if anyone can be a friend with a VC, but yeah, I like VCs. I do lots of deals with VCs. We do that all the time. I mean, they fund my companies. They make a lot of people rich. God love them. But those deals are bigger and they're fewer. The angel deals are just constant. They're just constant. Just every day, angels are getting into the act. There's just you saw I put my graphic back up. The angel market, people are really surprised by this, and it's been true for a long time, and I've known it's been true, is that there's as much angel money out there as there is venture capital. Angels invest as much as the VCs do, or pretty close to as much. So look, this is fundable. $20 billion, $22 billion in venture. This is 2016 numbers, but the numbers are probably even more angel money now, right? So there's a lot of angel money. They're the fuel, they're the engine for this Silicon Valley economy. They don't get enough credit, enough respect, because they're doing way more deals. They're smaller, but way more deals.
What is the range for an angel right now? For an angel
It's
VC?
really high right now. Like, these numbers are already out of date. Like, it used to be, $50,000. That's an angel deal. Now people come to me and they say, I'm going to raise, $2 to $4 million. There was a time when, well, you have to go to the VC. Nobody else has that much money. Well, angel groups do, or the micro VC funds. So $1 million is an angel round. $2 million is an angel round. Yes.
So do angels make money same way as the VCs by M&A and IPO, or
Yeah,
what's the difference?
Yep. They just hang in there till exit. They just hang in there. Yeah, that's what they all do. No, not very often.
What percentage of the deals wind up being M&A versus IPO?
All the ones I do are M&A. I mean, there was a time when it was, we did a lot more IPO, but then Dodd-Frank, no, it was Sarbanes-Oxley came along and kind of ended that party. So yeah, way more M&A, way more M&A.
So typically, what qualifies a company to go IPO? The valuations, the size?
Yes, the valuation, the size, the market, and the calculus you go through with the investment bankers, because I've sat there with them and kind of thought this through, and they say, well, gee, if we got public liquidity, what's our market cap going to be? And you compare that against, and if we sell to big public company, how much is that going to increase their market cap? Now, that's as much as I know about the space. That's way beyond my pay grade, but that is the calculus.
So you obviously talk about like Merrill Lynch or Lehman Brothers or similar investment bank that would take you public.
Say that again. What about them?
So typically, when you say investment banks,
Yes, that's what I mean. That's what I mean. A big investment bank that would take you public, or a small investment bank for that matter.
So you mentioned something about Reg A, $50,000, but it's very expensive to do. That's because you're going IPO almost.
Reg A Plus is a securities law exemption. It came in with the Jobs Act in 2012. They call it Reg A Plus. It allows you to raise up to $50 million from accredited or non-accredited. Because the problem we have in securities law is you can only raise money from accredited investors. People hate that, right? They want to take it from everybody. Okay, so Reg A Plus says you can take that money from everybody, and you don't have to do a public offering. Instead, you just file these statements with the SEC. But the statements you have to file are almost as bad. It's fairly onerous. It's fairly expensive. It's going to cost several hundreds of thousands of dollars to do. So in Reg A Plus, there was a big promise, that here's our mini public offering, but it didn't work out that way. It's still just too expensive. Let me ask you, because I've had people come to me and they say, oh, gee, I can do this Reg A Plus deal. I found a law firm that's going to charge me, $500,000, and then I'm going to raise 50 million. And I say, that's great. What if you don't? What if you don't raise 50 million? What if you don't raise anything? What if it fails? Where you're just out $500,000. And once people think about that, they don't want to do a Reg A Plus deal anymore. So I'm the Reg A Plus executioner.
What's a typical upfront cost for like an ICO or an IEO?
that's all over the place. Like an ICO, the way I do it, first we do a SAFT, which is very little. You know, I say very little, but like any other Reg D offering, it could be if you got one investor who's your uncle, you know really well, you got a couple $1,000s in the documents. So figure like $25,000. If you're going to do the full ICO and we go through Singapore, you're going to have probably $100,000 in fees by the time you're done, because you're going to have 25 to 50 on the US side and another 25 to 50 on the foreign side. So I'd say about 50 is usually where they end up.
Do they take that in as part of the
Yeah,
equation,
see,
or is
that's
that
the
an upfront
no,
cash?
that's the beauty of it, because you do the SAF, the simple agreement. You go out, the money you raise up front. In fact, there are companies that used to do this through a Reg CF crowdfunding. They do that really expensive $1 million on a platform, and they take that money just to build the software and pay the lawyers. That's all they would do with it, right? So you do that with the SAFT now in a typical ICO. So you go out to your small group of accredited investors in the US and you say, look, we're going to give you one hell of a deal on these tokens once we build it, but give me $1 million because we need to build it and I need to pay the lawyers. And you know, you take your $1 million, you build a SAFT or you build the platform, and then you launch the token, and the $1 million of SAFT they convert into, you know, at a discount, they convert into the token. So that's the model.
Thank you.
Does that make sense?
Yeah.
I was just wondering, I know Andreessen Horowitz had a closed door session to try to influence regulation. Do you like, how do you see us catching up with other countries?
Yeah, I hope so. But in fact, there's legislation in Congress. There's a Token Taxonomy Act that would help. But I'm not going to get all political on you, but let's face it, we've got a system where it's really hard to get things into law, and this is not really a top priority. I mean, you know, I listened to all the Democrat debates. I didn't hear anybody mention it. You know, it's not something. It wasn't. Let's see. There's climate change. There's health care. And oh yeah, legalizing token sales. Those three things. You know, I'm not hearing that. So I'm not confident. And the SEC, they're really annoying because they could do all this by regulation. They could just so easily. And there's a group of lawyers here in the Valley that have given the SEC regulation. Say, here's a proposed regulation exempting ICOs, having regulation light over ICOs. As long as it's not fraudulent, you know, et cetera, and as long as it meets these parameters, let's allow companies to do that here in the US. So I don't have to keep sending people to Switzerland. And the SEC, what we got back is crickets, complete silence. They're not interested in looking at it. I teach a class on blockchain at Stanford, and I had a former head of the CFTC come talk to us. And I asked him, I said, why can't you guys catch up with the times? Why can't you just regulate it then? Do something. Give us some rules. We got no rules around this now. And his answer was really interesting. He said, well, if you think about it, this entire market, it's a big deal for you, but worldwide, it's less than 1% of the global capital markets, right? As an asset class, it's just not big enough for anybody to care. So I'm not optimistic we're going to get any good regulations anytime soon.
Do you allow people to sit in at your classes at Stanford?
Sure. Absolutely. Thank you. You can stay awake, you can sit in.
All right, we got time for one last question. Here you go.
Sorry, when are your classes at Stanford?
We just ended the semester, so it'll probably be another year. But if you're serious, if you're really interested, I record them all. I got slides. It's all on my website. You know, send me a card. I'll send you the link so you can self-study.
All right, let's give it up for Roger. All right, ladies and gentlemen, stay in your seats. We're going to do the raffle. Has everyone who wants to enter the raffle already done so? Your chances look pretty good. All right, Roger, you want to do the honors? Drum roll, please. The drum's in the back.
Joseph Ashwood.
Joseph, come on down. Well, he's collecting them. All right, I guess you already got a picture too. Next winner is, drum roll, please.
Gianluca Baglio. Oh.
Come on down. All right, you get a picture later. And the final winner is, big drum roll,
Roth ready. Roth ready. Oh, must be present to win.
Roth, going once, going twice, gone. Oh, you snooze, you lose. All right, we got one more opportunity. Big drum roll, please.
Somebody left my talk.
It happens.
Colby Lepore.
Colby, come on down. So, one more order of business. Repeat after me. Happy birthday to you. Happy birthday to you. Happy birthday, dear Roger. Happy birthday to you. So there's your cake for your 29th birthday and ice cream. So we're going to go there, cut the cake. If you want to see the video, go to youtube.com/ideaIPO. You want slides, email Roger directly. After party at the Hotel Nia starting at 9 p.m. Once again, drink sponsored by Royse Law Firm. And I also want to thank Royse Law Firm for sponsoring the cake and the ice cream. Enjoy.